Algonquin Power and Utilities Corporation, AQN. Is this a good buy? Time will tell, but today we're going to have a really good deep dive into what exactly is going on with this company and what you need to consider and what you need to be thinking about before you might decide to invest. So stay tuned, and if you enjoy the video, be sure to click on that like button and subscribe. Okay, so when we begin to look at what's going on in the company, we can immediately begin to see this big price decline here. It hasn't been precipitous, but it has been quite a pronounced price decline. Now we can see over the last couple of years it's been at relatively high levels of multiples of price to earnings, but it's really begun to drop off here in the sort of September, October, November period, and quite a steep decline here in November. So is it a good buy? Now, if we consider that over the last 5 years, the company has traded at about 20 times on a price to earnings level, if we assume that prices began to revert to that level, we would begin to see a very substantial rate of return if prices increased to maintain that price to earnings level. But there's two issues at play here. Number one, the prices would need to increase to that point, and then number two, the earnings would need to stay at that level. So a couple of really important points down here. Earnings for this utility company, like many other utility companies, have been relatively steady. So we can see here that in the past they have been quite steady. However, when we get to the 2022 earnings estimates, they have, as we saw, 74 cents per share 3 months ago, 73 cents per share, and then all of a sudden it drops to 67 cents. And that's quite concerning. And in a similar pattern out the 2023 results, we see again that big drop, and in the 2024 results we see that big drop. So there's a couple of issues here. Number one, these earnings estimates in the future are being revised downwards, which means that prices are not as likely to climb as high in the future. So we've got quite the issue there, and we're going to begin to dive into what's been driving this decline and begin to understand what we do next, or what we need to think about as investors next. Now, one of the reasons that I have been invested in the company, and I think a lot of people investing in the company, has been this very strong dividend growth that we can see over time, and it's been a really nice gradual increase at a really good rate. 61 cents to 67 cents to 71 cents. Now, this is an estimated value, and as we go forward, we can see the estimate here for 2023 is holding steady, and relatively small increase here in 2024, 2025, and 2026, perhaps a little bit of an increase there as well. But these are estimates, and one of the big questions is the company likely to be increasing their dividends at this rate, and what's going on here? Part of the picture we can begin to see as we look at the capital expenditures. So again, if we're thinking about 2021, we can see this relatively large jump in the capital expenditures, held relatively constant this year, and again quite a substantial increase in the capital expenditures for 2023. And we can sort of see this trend. As a utility, yes, there are big capital expenditures. Now the company itself has been managing these reasonably well over the years. They're big capital investments. They've been growing at a very fast rate, and they've been doing this with a reasonable amount of debt. Now, is that a good thing? Well, they've been managing it all very successfully up until this point. But what are the implications? Let's have a quick look. Here we have the net debt to EBITDA. Now, as we can begin to see, in 2021 we're talking about 5 to 6 times. 2022 we're talking about 6.5 times, and then we're estimating in 2023 7 times. So we're talking about a substantial debt burden for this company. Now that is concerning, and essentially what we're talking about with debt at this level is we're talking about a company where the managers have to be incredibly careful. If something goes wrong, if there's some issues with debt, with repayments, with interest rates, with projects, it can be quite a serious issue when you're talking about debt levels of this magnitude. Now, in the past, as we can sort of see in the last several years, debt levels have been relatively low. There was a bit of a spike there, but at manageable levels. At this level, particularly with interest rates rising, we're in a situation where this is concerning and potentially a risky proposition for the company to be in. Now that was on the ticker terminal. I quite like the platform, but I'm turning now to Finbox to try and get a better handle on some of the granularity for some of these estimates. We can see here capital expenditures forecast. It's increasing in the near term, and that's the overall trend. But what we can see is we can sort of see this median set of forecasts, or the average set of forecasts here are for, again, quite strong increases in capital expenditure. I personally think that is going to have to come down if the company is going to be successful in moving forward. Now, as we can see, dividends per share, the average forecast is to sort of keep these relatively constant or very, very, very small increases over time. But in fact, if we actually begin to look at the low forecasts, they're talking about some actual decreases. There's one analyst here who has a reasonable expectation of a substantial drop in the dividends in the 2023 year before perhaps they pick up again in the future, in the coming years. So that's something to keep in mind. So not all the analysts are expecting that the dividend is maintained, and I think it's going to be very challenging for the company to maintain the dividend at this level. So there's some serious challenges for the company here. Now, one of the big issues is the EPS forecasts. So the EPS forecasts here, we get this low analysts, or the lowest of the set. The analysts are expecting a decrease in the EPS over the next year. A couple of years from now, relatively similar to what it is in this financial year. And so we can see some pretty concerning sort of trends here in terms of what's going on. So we can see, quite a low level of forecasted EPS here by at least one analyst, and that's not unsurprising due to the announcements. So what exactly has been going on with the company? We're going to have a quick look at that next in the company's own words. So I'm back on the ticker terminal. I am using the transcript function, looking at the last set of transcripts. So let's have a look at what's going on here. Net earnings, they've been increasing the interest expense because of the amount of funding that they've been using to grow. So that comes back to, again, the importance of debt in this business model for this company, and that increase in the underlying interest rates. They've got an increase in the tax expense as well, lower year-on-year recognition of tax credits, revised estimates associated with the renewables projects. So we've sort of got two slightly disconnected issues here that have affected them at the same time. Here's another issue, a slightly increase in the number of the weighted average number of shares outstanding, which was used or issued to fund the Kentucky Power Station. And this is all a bit of a challenge here as well, because that's all been pushed back, I believe, a little bit as well. So we've got basically with the company a number of challenges for them, a number of sort of relatively small factors and combining at the same time to begin to affect their earnings, leading to that depression in the earnings for this financial year. Okay, so do they think the dividend is safe? Well, I thought the analysts here on the call could have pushed the company just a little bit harder on some of these points. Quick question from this analyst about the dividend. What's going on? Are there any comments here on the payout strategy going forward? So the company's basically saying, hey, look, we've set a target of about 80 to 90% payout, and pretty much kind of, non-committal here. They basically just say it's going to fluctuate from time to time. Now, the company does seem to be quite committed to the dividend and the shareholders, so it's really hard to tell what's going on here. Now, what we can do is we can also flick over to see, what do the company insiders think is going on here? What do they think? What do they feel about the company and the success and the prospects for the future? Okay, so again on the ticker terminal, I'm looking at the ownership and insider transactions. So what we can see in November, as the news has sort of been announced about the challenges that the company's going through, we can see a relatively large uptick in terms of the sort of the insider transactions going on. So we're talking about quite a large purchase here in November. 120,000 shares is a substantial purchase, even at $10 a share for a senior member of the officers of the company. So this is quite a big vote of confidence in the company itself and their success and likelihood of success going forward. And we can see, in the next day, additional purchases there. But we can also see other senior officers, even in December, buying the shares as well and picking up shares. Again, much smaller value, but we can see a reasonable amount of activity here from insider buying, suggesting that the insiders are seeing value as a long-term holding. Does that mean that it's valuable for the rest of us? And that is a question that each of us will have to answer. Is this a buy? Is AQN a buy today for a dividend investor? And the answer is this is going to depend on your own risk profile. Yes, there are certainly risks here, but there's also potentially quite a bit of opportunity. Now, I've gone back to fast graphs, and here we are looking at the historic averages, and we can see this big price decline here in the last couple of months. It has been significant. It has been substantial. It's taken us well below this sort of expected line here in orange that would sort of tie the prices to the earnings in a reasonable ratio and a reasonable set of expectations. At the moment, if the dividend was maintained, we'd be talking about a 10% almost dividend yield at the current share prices. That is a strong dividend. But as we can also see here, the dividend's been increasing at a much faster rate than these earnings, and this decrease in the earnings this year has basically led the company to a situation where we might be expecting greater payouts than they can actually afford based on the earnings of the company. Now, as we've seen, look, they've got big increases in capital expenditures coming up. I personally think they're going to have to scale that back. If they don't scale it back, I would be very concerned about the dividend safety in the near term. In the long term, however, I think that even with relatively modest growth rates, if they don't cut the dividend very much, I think we could still look at this dividend at this level as a reasonable buy at this point, although there could be a downtick in dividend payments, perhaps for a short period of time. If you're looking to hold this for a long period of time, it could provide you with some reasonably good yields over a period of multiple years. The big proviso is, what is the company going to do about this debt? What are they going to do about the capital expenditure? And how are they going to bring this into balance? I think they're very much stretched. They've got a lot of debt. They've got a lot of challenges moving forward. So this is a potential buy. You'd have to take those serious debt levels into concern. You have to take the risk of dividend cuts into concern. If you absolutely have to have that income to survive, if you're relying on that income, I would certainly give this a miss. This is certainly falling into the category of a more speculative investment opportunity in utilities. Those are my thoughts. Let me know what you think. Hit up those comments below, and if this is useful to you, if this video is valuable, hit subscribe, hit the thumbs up, and I will see you again soon.